My name is Richard Kai, President and CEO of the Institute of the Americas located on the UC San Diego campus in La Jolla, California. I'm pleased to welcome you to day 2 of the Institute's virtual forum entitled Challenges and Opportunities in Central America's Northern Triangle region. Yesterday, in both the keynote address by Congresswoman Norma Torres and our panel discussion, the focus was on security, rule of law, and the governance issues. Both Congressman Torres and the experts on our panel discussed the many governance challenges facing the region. Our panel has highlighted that there are no quick fixes. What is needed is a 15 to 20-year approach to tackling governance issues in the Northern Triangle region in order to turn the tide and to begin to position the region for sustained economic growth and stability in order to reduce the high levels of outbound migration. Here, the key question is whether this can occur. To begin exploring this question, today we turn to the topic of the Northern Triangle's economic opportunities. We begin this morning with a distinguished panel of regional experts from the IMF, the World Bank, the IDB, and Fundesa. The moderator for this morning's panel discussion is John Andersen, the former Deputy Assistant Secretary for the Western Hemisphere at the U.S. Department of Commerce's International Trade Administration. I can think of no better person to oversee and moderate this session than John. John actually was very integral in the CAFTA, the Central American DR trade agreement, and was involved in virtually every other free trade agreement in the Western Hemisphere except NAFTA. So John comes with a tremendous amount of experience in the region, has a good understanding of the economic issues, the trade issues in Central America. So at this point, I'm pleased to present John Andersen, who will start the morning session. John, take it away.
Thank you, Richard. Good morning. And to those of you like myself who are participating from the East Coast, good afternoon. Welcome to our panel. As Richard said, yesterday you heard about many of the governance challenges facing the Northern Triangle, as well as the U.S. government's longstanding and renewed efforts to assist the region in overcoming these challenges. Today's sessions, beginning with ours, focus on the hurdles that must be overcome to ensure economic growth, commercial development, and a better standard of living for the region's peoples. Even before the onset of COVID, the economic situation in the region was problematic. COVID further exacerbated this situation as revenues and the jobs they support from both international trade and tourism were particularly hard hit. Natural disasters, including 2 tropical storms, a severe drought in Honduras, and 2 back-to-back Category 4 hurricanes that hit Nicaragua, Guatemala, and Honduras, did further economic damage. To help us understand the economic impact that COVID and these other natural disasters had on the region and the steps that we will need to be taken to surmount these effects, we have 4 expert panelists. From the Inter-American Development Bank, we will be joined by Marta Ruiz-Arranz. Marta, who has been with the bank since 2015, is currently the principal economic advisor in the Department of Central America, Haiti, Mexico, Panama, and the Dominican Republic, and previously served as economic advisor for the Andean region. Marta will be followed by Metodij Hadzi-Vaskov, who is regional resident representative for Central America, Panama, and the Dominican Republic at the International Monetary Fund. From the World Bank, we have Pedro Luis Rodriguez, lead economist of the World Bank's Central America Country Unit, covering Costa Rica, the Dominican Republic, El Salvador, Guatemala, Honduras, Nicaragua, and Panama. And our concluding speaker is Juan Zapata. He's Chief Executive Officer of the Guatemalan Development Foundation, Fundesa, as well as a columnist for several periodicals and an online magazine. Each of their more detailed bios are available online, and I urge you and encourage you all to take a look at those to get a better understanding of the depth and breadth of this expertise. As Richard mentioned, and before I retired from the Department of Commerce, most of my 35-year career focused on the Western Hemisphere. I work closely with the region's governments, the organizations represented by each of our panelists, and the US private sector, as well as private sectors throughout the region to help advance economic growth. I look forward to hearing the comments of each of our 4 panelists about the current challenges and ways to overcome them. During the presentations, you are encouraged to forward any questions. I think there's a link to do that. We will try to get to as many of them as we can after all 4 presentations are completed. So we will begin with an overview of the situation by Marta Ruiz-Arranz. So please take it away, Marta.
Good morning to all of you, and thank you very much, John, Richard, and the Institute for inviting me to this important conversation and sharing the views of the Inter-American Development Bank for the Northern Triangle countries. Let me share my presentation. So I will start with a brief overview of the economic and social impact of the crisis and the role of the IDB during the pandemic and the recovery phases. And later on, I will move on to more structural issues with regards to prospects of recovery and key opportunities to achieve a more sustainable growth. I assume you are seeing now the presentation. Please confirm, John. Okay, thank you. So you can see the that economic social impact of the crisis and the tropical storms from last November were significant in these 3 countries. However, the impact has been heterogeneous across the 3. GDP in 2020 contracted by 8.5% and 9% in El Salvador and Honduras, respectively. This is a larger contraction than the one experienced by the Latin American and Caribbean region as a whole, which was 7%. And as a result, the estimated increase in poverty for these 2 countries is more than 5 percentage points. This represents, more than erases all the poverty reduction gain of the previous decade. On the other hand, Guatemala fared better. The contraction was just 1.5% last year, the smallest in all the Latin American and Caribbean region. And this heterogeneity is explained in part by the differential impact of the storms which caused significant damage in Honduras and less sizable in Guatemala. Also, Guatemala had less strict lockdowns. Mobility indicators fell by less, and as a result, economic activity and employment also fell by less in Guatemala than in Honduras and in El Salvador. The fall in revenues and as a result of the economic contraction and the increase in spending to support the economy have led to sizable deficits and an increase in the debt levels, particularly in El Salvador. How big were those fiscal support packages? You can see in the right-hand side picture that these were in absolute terms quite big in the 3 countries, but in relative terms, they were half the size of the average fiscal package in Latin America, and about 1/3 or 1/4 of the size in advanced economies. Now, if you look at the light gray area, what the economists call direct fiscal measures or above the line measures, they were quite similar in the 3 countries, between 2 and 3% of GDP. And this is interesting because the initial fiscal position of these 3 countries were very different. El Salvador started with a debt level of around 70% of GDP, Honduras 45% of GDP, and Guatemala around 25% of GDP. This is why this deterioration of the fiscal position, although unavoidable given the circumstances, need to be more carefully managed in El Salvador going forward than in the other two countries. Now, on the external front, we saw that remittances increased significantly and supported consumption and demand in these countries. We saw that they contracted at the beginning of the pandemic, but then they bounced back rapidly, and by the end of the year, remittances achieved historical levels in some cases, like Guatemala. And in 2021, these flows also have continued to grow, encouraged by the dynamism of the US economy and the US fiscal stimulus. But on the other hand, as in other countries in Latin America, and as John mentioned, the crisis exacerbated development challenge and exposed some vulnerabilities that pre-existed before the pandemic. High levels of informality, the weakness of the health sector, etc. And this has pushed, together with the loss of employment and income generating opportunities, a new wave of migration of the region especially to the US. Now, amid this crisis, the IDB group mobilized resources to support these countries. The IDB group approved $2.2 billion in resources to the three countries in the Northern Triangle, most of it devoted to the emergency, and also introduced new instruments for rapid response and more liquid to support the health sector and safety nets of these countries, and also to increase the capacity of the fiscal and monetary authorities to deal with the crisis. Now, going forward, the task of recovering from this pandemic and the natural disaster is daunting. In Latin America, most countries, it will take years for the countries to recover the level of GDP per capita before the pandemic. In the case of the Northern Triangle, it will be between 1 and 3 years. And that is why the IDB has been working on a strategy, a blueprint to support the countries to achieve greater economic and social development. And there are 5 areas of priority. One is regional integration, 2, digital economy, 3rd, support the growth of small and medium enterprises, 4th, gender and diversity, and 5th, climate change action. And we believe that progress in these areas will contribute to return to the path of growth and achieve greater development. For the Northern Triangle, the speed and the success of the recovery will depend on several factors. And the Vision 2025 of the IDB is helping the countries navigate these challenges. Let me mention 4 of them. One is the management of the pandemic and the vaccination process. We know that the pandemic is not over and supportive macro policies will have to remain in place, or even though the country's capacity vary in terms of how long and how big these policies could remain in place. Also, the vaccination rollout process has been uneven in the region, with Guatemala and Honduras being way behind other countries in Latin America with less than 2% of the population vaccinated. El Salvador is more advanced with 17% of the population vaccinated. Now, another factor that will determine the recovery will be the preparedness or readiness to face the changing external environment. We know that so far the rebound in the US has been good news for the region in terms of remittances and higher external demand. But we also have seen higher oil prices. They are above pre-pandemic levels, and this is adding pressure to the fiscal and external position of these oil importing countries. So going forward, we also envisage tighter financing conditions. So the countries need to be ready to adjust, to respond, and to mitigate potential negative implication of this a more negative external outlook. A third item will be how the countries manage the recovery and the policies needed for this recovery and other risks like natural disasters. The IDB has supported Honduras, Guatemala, of course, and Nicaragua after the hurricanes Eta and Iota, and is also supporting all countries in terms of mitigation and adaptation to climate change. And in the issue of management of policies for the recovery, I will just emphasize the importance of creating the consensus and the political and social viability to implement the reforms and the measures for this recovery. So in the lack of this consensus and this political viability, the prospects for recovery will be hindered. And finally, a successful recovery will also depend on whether these countries are able to take advantage of key opportunities that have arisen as a result of the pandemic. And I will focus the remainder of my presentation on 4 main areas of opportunity going forward. One is improve social spending, including on health and education. The second is expand infrastructure investment. The third, relocation of global value chains. And fourth, improve skills of the population. So in terms of the first area of opportunity, improve social spending, we saw that the pandemic exposed how weak the health sectors and the safety net sector of these countries were. So there is an opportunity to strengthen them. We also saw that the pandemic affected women disproportionately. And, but in some cases, this stepping up on social spending will require improving efficiencies, increasing efficiencies, and also increasing revenue mobilization, especially in this case in Guatemala. When total revenues to GDP are so low, it's impossible to attend the social needs of the population and to continue closing development gaps. At the same time, we know that high informality constrains governments to achieve greater resources, and also it prevents the increase in the coverage and the effectiveness of the social safety net. So we believe that in the face of increased poverty and inequality and potential social discontent, this is an opportunity to renew efforts to tackle all these issues in a comprehensive way. We believe that fiscal reforms, labor market reforms to encourage formality, and reforms to strengthen the social protection systems are part of the same problem, and that it is also important to address them with a perspective of gender to avoid that the gender gaps widen further. On the second area, opportunity, expand infrastructure investment. It will be important, especially in the areas of logistics and connectivity, digitalization. A recent study shows that there is a big development gap in infrastructure in all the Latin American region, but in particular in Central America and in the Northern Triangle. And we also know that each dollar channel for infrastructure has a multiplier effect and produces $2 or more in terms of income. The region is lagging behind in terms of infrastructure of connectivity and access to internet. And this crisis has also highlighted the importance of having access to these, to digital technologies. Good news is that the pandemic gave us, gave the region a lot of opportunities. A recent survey of the World Bank, the enterprise surveys that was done during the pandemic, there's been 3 rounds of surveys to firms, show that more than 50% of firms started or increased online usage during the pandemic. So there is a role to step up efforts in this area. The third area of opportunity is take advantage of the relocation of the global value chains. You may be familiar with the results of the analysis by McKinsey, UBS, and others that show that many firms want to strengthen the resilience of their global value chain, that more than 75% of US firms that operate in Asia are already shifting some of their global value chains closer to home. So these countries are in a good position to take advantage of this global trend of optimizing global value chain, given their geographical location and that they have free trade agreements with the US and other major economies. But in order to do that, they will also have to step up efforts to continue improving the business climate and also design strategies to attract foreign direct investment, which is very low. And I think my colleague Pedro will discuss in more detail on these issues. And finally, the last area of opportunity would be to improve skills. The Northern Triangle has one of the largest young population of all Latin America, but they also have the largest level of dropouts, the largest share of youth that are without employment or not in school, the so-called minis. And if we want to generate opportunities, employment opportunities, attachment to their countries and reduce migration flows, there is a need to increase, to improve skills. There has been also during this pandemic efforts to retrain unemployed workers to provide opportunities for upskilling, and this is good news to generate, to increase their employability and to generate attachment, but more needs to be done going forward. To conclude, I just want to say that the challenges ahead are very significant, but we also believe that the opportunities are greater, and progress on all these 4 areas will create opportunities for a more inclusive, more sustainable growth and for greater economic development. And the Inter-American Development Bank, with its strategy 2025, is ready to continue supporting these countries in the journey ahead. So I conclude here. I thank you all for your attention. I remain ready for the discussion later. Thank you.
Thank you, Marta. That was very informative. And now we'll have a presentation by Metodij.
Thank you very much, John. Richard, John, and the Institute of the Americas. Let me first thank you for this kind invitation for such an important topic for the whole region at a very critical juncture for the whole region, and especially for the Northern Triangle. So in this presentation, I'm just going to focus on the heterogeneous impact of the pandemic in the region, in what we call the Cape DR region, so covering Central America, Panama, and the Dominican Republic, and of course, when relevant, just focus on the 3 countries of the Northern Triangle. Just as a heads up, the presentation is going to zoom in into more macro and financial aspects of the ones that already were put in the overview presented by Marta. Next. So at the beginning, before I go into the slides and the different charts, I'm just gonna give you a brief overview about the 4 key points of this presentation. So it's gonna be first, just to document the impact, which has been very significant in terms of affecting lives and livelihoods of the countries in the Cape DR region. Second, some views in terms of the recovery and the expectation that this recovery will likely be quite uneven across countries and across sectors, and of course, subject to a lot of risks. Here, in terms of risks, in addition to some possible COVID resurgence in the period ahead, we also think, and we have been reminded last year about again and again about the very important risks related to climate change, especially in the region. Third, as the health crisis recedes, the policies will need to strike a balance, and this is the most difficult and the most complex task for policymakers on the macroeconomic side going forward, to strike a balance between further supporting the recovery in the region and at the same time ensuring fiscal and financial soundness. And finally, I'm just going to touch also on the substantial support which the fund has provided as emergency financial assistance to all countries in the Cape Verde region. Next. So when we look at the beginning of the crisis and the impact, the first thing to note is that the inadequate health infrastructure, and here we mean basically the inadequate hospital beds, the inadequate systems for testing and for tracing in many of the countries in the region, actually they forced the authorities to implement early on strict lockdowns. Of course, the stringency of these lockdowns depended on the country circumstances, but what we see in the left chart is that pretty much all the countries in the region lag behind in terms of hospital beds, lag behind Latin America and the Caribbean as a region, and lag the global factors in this indicator. So in the middle chart, what we see is that this had implications because we had three more or less significant and identifiable waves of the pandemic in the region. And with all these waves of contagion, basically the countries had to implement quite strict containment measures, especially in the first wave. And one of the cases that we can just point out here is El Salvador, in which the measures were very stringent. So as you can see in the sharp increase in the gray line in the right chart, and then this created some space to beef up the capacities of the country in terms of testing and tracing of the disease, and of course to strengthen the temporary medical facilities. Going forward, the adaptability of the countries to this shock, of course, facilitated and made the stringency of such measures smaller in the later two waves of the pandemic. Next. And of course, when we talk about the impact, the key issue here is on all our minds is the vaccination process. And there are two dimensions that are probably the most important to mention in terms of the vaccination and the impact on economic activity. First is the number of pre-ordered COVID-19 vaccines. And in the left chart, we see that the region, especially some countries in the region, are lagging significantly behind in terms of the number of pre-ordered vaccines, especially the Honduras. On the right side, what we see is another dimension is the administration of the vaccines, which have already been received. And here we see that this is proceeding at various speeds. So some countries are doing a lot of progress, but at the same time, we see that, especially for Honduras and Guatemala, this seems to be a particular challenge at the current juncture. Next. Of course, the process of vaccination will determine a lot the economic prospects going forward. And here I'm just giving a brief snapshot of our projections for the region and compare it with the LAC region from our April World Economic Outlook. And here what we see is that actually the Cape Verde, although it gets slightly better, they are slightly better than the region as a whole in the initial phases. Still, overall for 2020, the result for the region was only slightly less negative than for LAC as a whole. Just one point to mention here, some of the countries, we have 4 countries in the footnote that had actually some updates in terms of the growth projections since the view was published in April. And going forward, we see that the projections for 2021 are positive. So all of the countries are expected to register some growth, and some of them much more than the others. For instance, we have a very strong recovery expected in Panama, but also this is partly a result of the very sharp contraction which took place in 2020. One important message to take from the expectations that we have about the recovery is shown in the chart on the right. And here we see what was actually what is the overall impact of the pandemic. So for the region as a whole, GDP is expected to reach the pre-crisis, the pre-pandemic levels only by 2022. If we go into individual countries, this is true for most of them. So basically, they will only reach this level still in somewhere next year. Next. And in order to understand the differences in terms of the economic performance and the recovery going forward, we can see that the recovery is already progressing in the left chart, but it is uneven across countries. We can see that Panama, for example, has been hit very hard, and despite this upturn, it is still it still has a way to go. On the other hand, Guatemala has been, as explained earlier by Marta, basically the recovery, the shock was milder, and also the recovery seems to take ground quite soon. So this is explained by, for example, several differences in terms of the sectoral composition, as we can see in the central chart. The recovery in tourism, for instance, seems to be slowly taking hold. However, this is of course encouraging sign, especially in the last few months, but there is still a very long way to go. We show here the results for Dominican Republic and Costa Rica, given the importance of this sector, but this is in general for the sector as a whole. And when we look at the right chart, we see that shipping, which reflects a lot global factors, has still been subdued, and this is one of the very important sectors for Panama. Next. And looking at the sectoral composition, just very briefly, to show one of the interesting findings is that agriculture has indeed fared much better than many other sectors, and it was much less affected in the first months after the start of the pandemic. In the left chart, what we see is that the black bars are indeed very small, meaning in Guatemala, they're even positive. So meaning that actually agricultural production has declined the least of all major sectors, especially compared to the sharp decline in terms of services as shown by the blue bars for commerce, transportation, and leisure. Similarly, in the right chart, we show that the contribution to the resilience in exports in these countries has been exactly provided by those with higher share in their goods in agricultural products, as shown by the purple bars. So for instance, Guatemala, Costa Rica, and Nicaragua. But at the same time, what we see is that the important part is also the green bar, which shows some of the medical and pharmaceutical products which have been also quite resilient and kept exports growth or the decline milder. Next, please. And if we focus, for example, on the traditional maquila sector, what we can see in the chart on the left is that countries like Honduras and El Salvador that have a relatively higher concentration of their exports in traditional exports such as textiles and footwear have indeed fared much worse in terms of the export growth until December 2020, because we see that the decline in overall exports in these sectors was much more pronounced. However, going forward, the latest data are showing some signs of encouragement, at least if we see in the right side, that exports overall seem to be picking up across the region, of course, with different speeds across countries. Next. So this brings us to some of the policy efforts and the role that the fund has played in the countries, and some of the policy recommendations we will share. We are currently sharing with the countries. Next, please. So the important thing is that, well, despite the large losses in last year, basically output gaps are still expected to narrow gradually in all countries. In the left chart, we show that countries that actually experience larger declines in economic activities, they also face much larger employment losses. So this relationship has been very steady, and even if we take into account some of the outliers, such as Panama. In the central chart, we show that this decline in economic activity indeed led to production being way below the potential. And as we can see in this chart, the output gap in 2020, shown by the blue bars, was indeed very large across the region. And in 2021, it is expected to only gradually start narrowing. Of course, one of the indicators on the demand side of all these developments is that core inflation, despite a decline in some of the initial phases of the pandemic, when this gap in economic activity has opened, still the factors, overall countervailing factors with the development of the dynamics of the pandemic actually led for core inflation to start stabilizing in later months. Next. So what do these general facts give us for policies? So monetary policy has been very, very important in the crisis and has actually provided unprecedented support in many cases. And of course, this was combined with the with regulatory measures such as regulatory forbearance and relaxation of some credit risk regulations. Monetary policy going forward should, in our view, should keep continuing to support activity and to support the recovery because of several reasons. So first, in the right chart, what we see is that despite the strong monetary stimulus so far, inflation expectations seem to remain well anchored in the region. As we can see, that they're mostly within the target ranges or even below in some countries that don't have a target range. So these stable inflation expectations, together with the still remaining large output gaps, suggest that this monetary stimulus, as shown with the policy rates in some cases at historically low levels in the central chart, they should continue to remain accommodative and support the recovery in the near future. Of course, on the credit side, some of the measures which were done to support liquidity and to support private sector credit, they have been very important. Nonetheless, there seems to be scope to continue supporting private sector credit going forward, because if we see in the right chart, what we compare here is basically the growth of private sector credit, as shown by the blue bars, and the growth of private in 2020, and the growth in the pre-pandemic year in 2019, shown by the red circles. So what we can see, with the exceptions of two countries in the whole region, so the credit dynamism seems to be still behind what was there pre-pandemic. Therefore, opening some scope for further stimulus going forward. Next, and this indeed brings us to the second part of the same coin, which is, while supporting, while continuing to provide this monetary stimulus and supporting credit activity, overall, all the countries in the region should be very cautious about safeguarding financial soundness. And in this way, it's especially important to bear in mind the risks associated with regulatory forbearance. So what we see here is that all countries in the region at the beginning of the pandemic and even throughout the crisis have had their banking sectors well capitalized with capital adequacy ratios which are quite solid. Nonetheless, what we see in the middle chart is that credit quality is expected to deteriorate, and some signs are already showing. So if we see the increase in non-performing loans in several countries in the region, as shown by the blue bars, they already seem to be picking up. So in addition to the non-performing loans, some banks voluntarily have started increasing their provisions for NPLs. This is shown by the increase by the red circles in this middle chart, which shows that basically there has been increase in loan provisions in most of the countries of the region. And this is not surprising. I mean, if we see the number the share of loans that have actually benefited from credit moratoria and other regulatory forbearance measures in the right-hand side, here we see that this is really significant, and this is, of course, a source of potential risks going forward, because there is still a lot of uncertainty about the real quality, underlying quality of these credits when, of course, the circumstances normalize. Next. So this being said, we go to the second and especially important policy that supported all countries across the world, but also all the countries across the region. So here, the fiscal stimulus was substantial, especially compared to historical norms in the countries of the region. And as it was shown in the previous presentation, basically, we see all the countries from Cape DR, we see that the measures both above and below the line have been significant for the region itself, but they're still lagging behind, significantly behind emerging markets in general. This can be shown in the chart in the left, and even lagging behind the larger economies in Latin America. So I'm not going to repeat what was already mentioned, but this, to a large extent, this of course reflects the policy space and the fiscal space that these countries faced before the start of the pandemic, which was uneven. Looking at the composition of this stimulus, what we can see in the middle chart is that most of the countries used different types of measures, so both on the revenue and expenditure side, but in general, the expenditure side for the countries that we are covering here in the region has been somewhat more important than revenue measures, at least in most of the countries in the region, with the exception of Honduras, which had more focus on the revenue measures here. And third point to mention in terms of this fiscal deficit, these have been really substantial for the countries themselves, and of course posed a lot of challenges how to be financed. So a number of countries resorted to international markets to finance their deficits, especially from the Northern Triangle. Here we can just point at El Salvador and Guatemala, but also the other countries in the region. Of course, this is one of the aspects I'm going to cover more in detail later. Next, please. So, as a complement to all these efforts, the International Monetary Fund has provided a substantial financial support to the countries in the region in 2020. So what we show in the chart on the left is actually the total emergency financial assistance disbursed or approved in 2020. And here we see that for all of the countries received assistance, and most of them, actually 6 out of the 7, were approved special programs that were put in place exactly for emergency purposes. And Honduras, which already had a program in place, actually got disbursement under this program and also augmentation of his excess. Why is this important? Is because these countries, among other things, they faced they didn't face all of them adequate buffers in terms of foreign reserves before the pandemic, as can be seen by our reserve metric on the right side. So this was really a critical support at a very important juncture for the countries. Next. So going forward, I mean, just to put in perspective all the fiscal response and the types of financing that these countries managed to get, is to mention that this fiscal support should continue to support the recovery going forward. However, what we need to emphasize is that the withdrawal of the fiscal support will need to be gradual but concrete as the recovery takes hold. So just to give you a brief overview, of course, a lot of countries already had elevated debt levels, as mentioned earlier, especially the case of El Salvador, and the pandemic, of course, increased the level of debt even further. In the central chart, this actually shows us that the borrowing costs have remained very high, especially for some countries such as El Salvador. And of course, this has posed a lot of challenges in terms of, and may also be important going forward in terms of financing these deficits in the recovery phase. So what we have in the right chart is the change in the primary fiscal balance. So what we see is that 2020 saw a very sharp deterioration in the primary fiscal balance, and rightly so, in order to support lives and livelihoods and support the health sector, the vulnerable groups, and of course, provide critical support to companies. However, in 2021, there is some withdrawal of this fiscal stimulus, which in our estimation is going to be quite substantial, but still gradual. So overall, the picture for the region seems to be in line with the basic point and the basic recommendation shared before. Next, please. And this brings me to a very important point, which is the financing needs, how they have been and how we expect them to be going forward. So financing needs, if we see the left chart, already in 2018, 2019, before the pandemic, they have been substantial. With the pandemic, these have increased substantially for some countries, as shown by the blue bars. Despite some a reduction for most of them in the recovery phase, at least based on our baseline expectations of the fund. So as shown by the orange bars, this financing need will remain substantial. So for many countries, even above 10% of GDP. And moreover, in historical perspective, they will remain much higher than the pre-pandemic period and the difficult episodes of the past. So where does this bring us? So if we see the right chart is the fact that for most countries, even going up to 2023, the change in debt will still be positive, meaning that public debt overall will keep rising under the baseline assumptions. So not only in the region, but also in broader in Latin America and emerging markets. So this will imply a lot of emerging markets having the same issue with large financing needs and tight financing conditions going forward. So if the public sector is quite restricted in this case and will face such conditions, this brings me to one of the important topics that especially we are trying to tackle in today's session. It's if the public sector is really restricted so much, how can the private sector help and reinvigorate private investment and support the recovery going forward? It may be a critical component of the recovery going forward. Thank you very much. And I'm looking forward to the discussion and to the responding to your questions going forward. Thank you.
Thank you, Metodij. That was fascinating. An excellent presentation. We are now going to hear from Pedro Luis Rodriguez, lead economist of the World Bank Central America Country Unit.
Can you guys hear me?
Yes.
Thank you. No, I just got a message that I needed to be unmuted. So thank you very much, everyone, for organizing this very important forum for these countries, obviously, and for asking us to join this excellent panel of professionals and friends. And I'm including you, John, because your experience is very relevant on trade and investment facilitation. I just wanted to take on where Metodij and Marta left, and let me see if I know how to. You guys are all seeing my slides?
Yes, your slides are up.
Full on. Okay. Well, I should start by saying that obviously, maybe one of the reasons why we are all together today is because of the immigration pressures that are coming from these countries, and it's going to be a difficult challenge. But worth trying, right? So there is light at the end of the tunnel. If we just look at some of the papers that are included in the International Handbook for Migration and Economic Development, there is what they call the mobility transition theory, which suggests that that migration rises, right, with economic development. So when you are very underdeveloped, your population just don't find enough economic opportunities. But as the countries reach upper middle income status, the graph on the left, I couldn't paste it in a more transparent way, but more or less when you get to the $5,000 or $6,000 per capita in PPP terms, your migration pressures start to slow down. And I just wanted to tell you where these countries are. So obviously, we can call Guatemala already an upper middle income country with $9,000 per capita, but Honduras and Nicaragua has some way to go. But still, so worth thinking about not just the migration issue, but the development issue as well. So my first message in this regard, I forgot to put it. I just want to give you two messages, so very quickly. I don't want to underestimate the challenges, right? And there are many, and I think Marta gave us a fantastic overview of some of the challenges that the country faces, both domestically as well as from external factors. But I wanted to say that we are off to a good beginning in the past 20 years, and in many ways actually setting the stage for Latin America, not just for Central America. So, for example, growth in over the last since 1991, so it's almost 3 decades, in El Salvador has been quite commendable, per capita at about 4% per year. Much less in Guatemala, in particular when you look at per capita terms, about 3%. And the same thing, a lot much less in Honduras, which has grown a lot. Obviously, the demographic there is also implying that they need to grow much faster. This is very sensitive, so I'm trying to calibrate well my fingers. So the second point is, that said, I mean, there is a major issue of productivity, and I'm just showing you guys here the growth in labor productivity over more or less the same period. By the way, LAC as a whole has been terrible, right? So that's excluding the C6, which are the same countries that Metodij was mentioning. But LAC has been terrible, but El Salvador, Guatemala, not very prominent, and Honduras, and maybe we don't need to aim for the levels of productivity growth that we see in East Asian and the Pacific region countries. But I mean, Panama has not done bad. So within the region, Panama and Costa Rica are interesting examples. Now that has a consequence that if you look at it at sectoral level, the productivity levels of these sectors are relatively low. I mean, about 5 to 10% of the levels that we observe in the OECD countries in 2017. And irrespective of the sector you choose, but agriculture obviously seems to be lagging behind, despite the fact that some of these countries export, I will show you later, highly sophisticated agricultural products. Agriculture as a whole has very low productivity in all the countries, the same as manufacturing and services. I mean, this graph is hard to read, and I'm sure we will share the slides, but it basically says there's nothing going on in the enterprise sector as a whole on average, right? So and this is El Salvador, what has happened with enterprise growth between 2010 and 2017. On the left, those bars are hard to read, but if you just focus on the yellow bar in the back, that tells you that enterprise with more than 10 years of age tends to have 2 to 4 employees. So literally, large enterprises that will employ more between 10 and 50 people just are almost inexistent, particularly when they are young. Of course, we always, what we would like to see, and I don't have the graph to compare it, but if you believe me, if you were to plot the US, the more years of birth an enterprise has, the more people they employ. I mean, you almost, it's not just more revenue, it's also more employment. So you don't see that dynamics here. And on the right, it's complicated, but it's also a sad story. You can read this from the top to the bottom. The most productive sectors in El Salvador are the utilities, interesting, in the top, and the banks, the finance and the insurance sector. So with productivity, with accounting for 2 or 3% of the productivity of the country. Now, these countries on the x-axis have not generated employment, essentially. The change in employment in the sector between 2010 and 2017 has been flat. So obviously, no wonder there is an issue of demand. I'm sorry, my green dots move here, but I wanted to also show you that you can see that lack of productivity also on the exports, and this is an interesting classification of the total exports of goods in these countries. And what you can see on Guatemala, which is on the second country, the second set of bars, I mean, almost 40% of their exports are primary products. The same, I mean, in Honduras, it's a bit more than that, 50%. And in Salvador, interestingly enough, Salvador has managed to export a significant proportion of low tech, not medium tech, low tech. You can see there East Asia and the Pacific on the right, or OECD countries. Obviously, and even the group of the 6 countries in Central America, where of course you see a lot medium tech coming mainly from Costa Rica. This is something that I didn't know where to show you or not. It looks a strange graph, but these bars essentially represent the minimum price and the maximum price that the commodities at which commodities traded in the world. So if you look at the bananas, for example, I mean, between 0 and 8, whatever the unit value is dollars, I guess. I don't remember the quantity, but about $8 per something is the maximum price at which you can sell in the world these days a banana. And the dot shows you that Central America is doing extremely well already on bananas. It's also doing extremely well in food, in prepared food exports. In some other coffee, for example, there is not a lot more room for increasing value of their exports. Pineapple is a different story. But of course, when you look at some of I don't look at sugar because it's a very heavily distorted market, right? So, but if you look at some other examples, but nutmeg or electricity capacitors, I mean, some of the manufacturing, basically these countries are located in the very low part of the quality ladder. So my second message, I mean, there is a lot of issues, and we've started to discuss some of them, including, for example, human capital formation or strengthening institutions that the countries need to do to reposition itself into a growth path. I mean, I just want to focus your attention on 2, which is to attract FDI and enhance trade integration. The integration that implies a deeper participation in key global value change. You saw this in Metodij slides. I mean, the community loss of GDP is large. And I'm not going to explain this, but there's a modeling behind it. But if you believe me, when you input reforms into those growth trajectories, you can really quickly, because the countries are small, the industries are small, you can quickly bend those lines, particularly the dotted red line, and make it a green light where you start growing fast and getting to the income levels that we all want, obviously the countries themselves first and foremost, but also neighbors and stuff that would like to see these countries growing. Now, I want to put this for discussions, right? There is no strong evidence behind it, and in particular, we know that, for example, Panama and Costa Rica has grown extremely well on their own. So the issue that I wanted you to think a little bit more, we all, is whether it would make sense to press to expand the markets, even at this point for Panama and Costa Rica, I would say. But and this is just essentially a graph that shows you what is the GDP in each country. If you sum the Central America GDP, it more or less gets you to the 6th largest Latin American region. And if we have investors listening or entrepreneurs, and maybe in Guatemala, obviously you prefer a larger market than a smaller market. So I think it's an issue to think about it. Given that COVID changed so much the rules of the games in most countries and our development models, maybe it's time to be opportunistic and try to already get a payoff in terms of expanding the size of the markets, which, by the way, has not been a bad example in. It has Central America by Latin American standards has not done bad at all in integration, trade integration or capital market integrations. But I wanted to show you that, I mean, there are some homework to do. This is also a very complicated and convoluted graph, but if you just look at the right-hand side, completely right-hand side, Salvador, this one tried to give you a percentage measure of the cost of non-trade barriers. And for example, when you export a good from El Salvador, maybe it's the opposite, when you import a good from Panama to El Salvador, the non-trade barriers, whatever they are, sanitary and phytosanitary requirements, technical requirements, border crossing requirements, basically that adds up a price of 100% of the value of the full value of a good. It's different in different countries, and this is a little bit outdated. There has been a lot of efforts between Honduras and Guatemala recently, maybe worth if Juan Carlos tell us, but it's an agenda still. So it's infrastructure probably, but it's definitely a lot of red tape and lack of simplification. I mean, the second fact that I wanted to leave with you is that, I mean, let's talk about Honduras a little bit separately, but both El Salvador and Guatemala just invest very little. We know basic growth theory, you need to invest and accumulate capital to be able to grow. Both capital, human capital, as well as physical, but in this case, this is the measure of physical capital, gross fixed capital formation. And the total amount, around 15%, I mean, this will pale against any country that has been successful in growing, both on the public side, which is less than 3% of GDP, and we just hear about the limitations in the fiscal rules that some of these countries face, particularly Salvador, but still you can see that they are doing very little in public investment, but equally bad in attracting private investment. And I'm just highlighting, although these numbers cannot be adapted so easily, but the FDI is really, really low in most countries. Now, Honduras is an interesting country because it's the poorest, number one, but it has relatively large investment ratios as well as trade ratios. So obviously there is an issue of efficiency there that one needs to investigate, or institutions that one needs to investigate. And since I mentioned institution, I will not cover it, but I don't want to forget that there are some horizontal conditions that needs to take place. And what I'm giving you is the rankings in the World Economic Competitiveness Report of 2019 of our countries in Central America. So these are just the ranking out of 141 countries. In some of the institutional elements that probably may or may not affect, depends on the industry differently, right? But judicial independence, obviously organized crime. I mean, El Salvador is 141, the last country, at least it was in 2019, which means are the numbers of 2018. In organized crime and homicide rate, maybe that has changed. Judicial conflict of interest regulation, property rights. I mean, frankly, even Costa Rica is not doing that well in that respect. So obviously, these are problems that cannot be fixed in one year or two or in a short-term horizon. But some solutions will need to be given for the business environment to improve, right? Whether it's to the defense of property rights and the proper arrangement for the justice system to deliver a proper defense of property rights, or whatever it is, we have to also think about it. And so let me stop here, John, and give you back the microphone.
Thank you. That was quite informative, and you raised a number of the really tough challenges that the region needs to deal with. So with this, we will turn to Juan Carlos Zapata and take it away.
Thank you, John. First, I would like to congratulate the Institute of the Americas for this forum, and thank you also for the invitation to this great panel. As you saw, many of the previous presentations focused on the challenges, and we in Guatemala, in Fundesa specifically, Fundesa is the Foundation for the Development of Guatemala, are focusing on the opportunities and the solutions that we think can help our countries to generate not only better development, but also opportunities for the region. During the first months of last year, we began to work with the government of Guatemala and the municipality of Guatemala within the private sector through Fundesa in a program that was later named Guatemala Moving Forward, in which we acknowledged the importance of what was happening worldwide. And as Marta mentioned, the shifting global value chain and the disruption of value chains from Asia to Latin America. So we within Fundesa, subcontracted an international firm to develop a strategy, and it was an investment of $3 million from companies from the private sector to support the government and the municipality of Guatemala to have this initial plan to not only increase exports, but also increase foreign direct investment in 25% in the next two to 3 years. So the opportunity is that we can actually increase jobs within Guatemala to around 2.5 million good quality jobs to the year 2030. Now, this is a 10-year program, and we have different initiatives that are already being done within different ministries. And with the support of the private sector, the municipality of Guatemala, let's remember that Guatemala City is the largest metropolitan area from Mexico to Medellin. So when you talk about investment, Guatemala, at the end of the day, is the motor of Central America. It's the largest economy in Central America, and it has the opportunity to generate new jobs, new investment. And I'm going to tell you a little bit of what the plan regards. The first thing is how Guatemala has defined an export increase strategy around 3 different blocks. The first one in the short term, to do more of what we are already doing well, and that is an opportunity to increase market share in interest markets. The second area on how to diversify with current competencies, boosting exports of adjacent products, and in the long term, expanding horizon towards more sophisticated sectors. And we're going to look at a little bit of what the opportunities are on expanding exports to new and more sophisticated sectors, leveraging, of course, the proximity to the US and nearshoring global trends that are happening right now. So for the first 2 blocks, we estimate an opportunity of up to $5 billion in 20 products in 7 sectors. And of course, how we reach this conclusion, there's more information that I can gladly share, but I tried to shorten the presentation as much as possible. And this chart shows specifically which are the main markets in products such as crustaceans, frozen fish, vegetables in forestry and fishing, food products. There's an important opportunity, chemicals also, plastics and rubber. The most important opportunity, if we look at the apparel sector, can reach almost $3.5 billion in new exports and generate almost 500,000 jobs within different intermediate cities, and of course, Guatemala City as well. The other part is how to increase non-metallic products such as ceramic sinks and electronic equipment, specifically on refrigerators. As you see, the opportunity range on new exports is almost about $5 billion, and this could almost generate more than 800,000 jobs within the country. Now, the other part is that we identified 4 sectors to attract investment at a scale in medium to the long term in 4 areas that are important and that are shifting toward from Asia to Latin America, specifically on pharmaceuticals, medical devices, electronic equipment, and manufacturing, and also business services, specifically business process outsourcing and ITO. Now, the most important area where we see the low-hanging fruit for Guatemala at this point is, of course, in the business process outsourcing sector, and specifically on ITO. Call centers are a great opportunity. Guatemala is increasing its capacity. The mayor of Guatemala is leading a tremendous effort to increase human capital and English learning within the city. And this is also spilling over to other intermediate cities. And this is a great opportunity for investment. And of course, also for US technical training on how to increase not only English, but also programming skills. Now, the plan began with the right foot, reaching almost 5 major milestones in the first months of implementation during the first months of this year. The first, that we formalize an effort through a public-private agreement led by the president, and you can see a copy in the website of Fundesa. The installation of sectorial technical roundtables with 10 conversations with investors and promotion agencies. We are working directly with the Ministry of Economy, who has the leadership, as well as the competitiveness program, the National Competitiveness Program, PRONACOM, on 8 bi-monthly meetings with a steering committee comprised both from public and private sector organizations. They also hired a investment attraction officer, who is Maria Eugenia Tabu. She's not only former director of Fundesa, she's also a former deputy within Congress. And preparation of first investment with the Embassy of Taiwan, the IDB, and the government of Guatemala. We're working together with many companies and many countries trying to attract more investment towards the country. Now, this strategy is not only about exporting sectors, although that was the first initial part. We are also focusing on human capital, which, as you saw in the presentations before, is one of the key issues on how Guatemala can actually increase its capacity to export better services. Develop centralized promotion vehicles, including funding, to train around 110,000 people. That we need $40 million in a fund that can actually start increasing the capacity of people to drive and accelerate English courses and also boot camps for programming. The enhancement of English and programming teaching in what is called diversificados, such as high school. Infrastructure, that's one of the basic challenges, as you saw, when we look at fixed capital formation in Guatemala is around 16%. 2% is public, 14% comes from the private sector, but that's one of the key issues where Guatemala can actually increase its investment through a strengthening unit to generate more projects. We're accelerating around 9 projects in the first part, where there's going to be increase on funding that is going to be needed around $3 billion, and how to strengthen end-to-end processes, and also implementing 10 reforms on Congress that are going to be necessary when we talk about legal certainty towards infrastructure. There are many initiatives that are already in Congress, such as the infrastructure build on roads, but also the importance on public-private partnerships, which is also an important issue within Congress at this moment. The other part is how to strengthen competitiveness and legal certainty, as well as rule of law within Guatemala. One key aspect right now is that Guatemala just approved a new law for simplification of administrative procedures, which is going to make Guatemala a digital state. It has the capacity to actually generate a movement towards digitalization in e-government. Within this law, the government has 2 years to implement all the procedures to have full e-government within all ministries. The approval as well of packages and reforms for competitiveness, the modernization of the judiciary, and also generate a global, a national agreement for transparency. Now, we are also working on the tourism sector, which is also one of the key issues of how Guatemala has the potential to position itself as a world-class destination, specifically on the Mayan Biosphere Reserve, but also on how to work with IRTRA, which is a park that can actually articulate various forms of development towards intermediate cities, and Lake Atitlan, which is also a project that can also spur a lot of investment for the region. Now, all this effort that is being closely developed by the government of Guatemala and the private sector, as well as the municipality of Guatemala, is one of the key efforts on how to reduce migration. As you saw, 80% of people from Guatemala migrate to the US because of economic opportunities. And what we see with the visit of Vice President Kamala Harris to Guatemala is that the conversation has to shift to how Guatemala can actually attract more investment, generate more jobs in the country, and increase opportunities. And that's a conversation where Fundesa can actually be a partner, and as well as other organizations within the private sector. So thank you very much, John. And we're going to be following up on the conversation and the questions.
Thank you very much. Thank you. Thank you, all of you. Because I don't want to run into having to do this with a minute or so left. Before we open up to Q&A, I wanted to thank all of our 4 participants. I think those were tremendous presentations. And I also want to thank all the attendees who participated in this session. I'd let you know that the entire session will be available to all registered participants on the WHOVA platform for the next 6 months. And the presentations will be posted shortly, right after the sessions. I think today's concluding session. And again, all registered participants will have access to that. I'm told that we have at a maximum of about 17 minutes for Q&A. And we do have several that have come in. I'm gonna start by asking the first one, and several of the presentations from our panelists touched on the issue of regional integration. And when I was part of the CAFTA negotiations, that was one of the key messages that the U.S. negotiators had to the Central American countries, that as individual economies, you're relatively small, but as a region, you're fairly big. And the more you can do to integrate, to make that customs union work, to act as a region in terms of policies and procedures, the more attractive you may be to foreign investment. So I'm going to open this up, and any of the panelists can answer. How do you see that happening, or what are the impediments from keeping that happening? Pedro, you want to have a crack at that?
Sure. Just to start by saying that obviously trade tariffs are probably not the biggest deterrent. We haven't actually studied carefully the binding tariff for many of these goods, and we should perhaps. In the bank we haven't done an evaluation of CAFTA-DR, for example. Also some of the rules of origin, whether they can accumulate, or those things that kind of segment the producers rather than help them integrate. But that said, obviously what the stylized fact that we'll have is that the difficulties, at least in goods, is really non-tariff barriers, is all the trade facilitation. Frankly, I've been working by now 2 years in the region, and I'm surprised that the institutions are relatively well set up, the integration institutions with the ministries of commerce discussing, and even with the abilities to sign treaties that has to be converted into local national law later on. So I think a few trade facilitation measures, and maybe this is something we should all think later, but just to put some on the table, needs to happen. I mean, one thing that we have all been working on, and I'm including here the IDB as well as USAID and others, EU, is for example on making the authorized economic agents, those ones that are well recognized exporters and importers in the region, and have credentials of risk management for the difficult issues that customs needs to inspect, drugs and this type of thing. There should have a green channel, right, and have a different treatment. Mutual recognition of these economic agents does not exist. So that's just to give you an example. The other example, and this is going a little bit more into services. You need mobility of professionals, right? And it needs to be cheap, because the services is, well, now we discover Zoom and other means, but you still need a lot of the interaction. in any consulting, whether it's auditing or accounting or some of the people that, for example, was helping Juan Carlos and Guatemala to develop their thinking on how to reposition the country. The tariffs, the air tariffs are super expensive. And you say, why is it that I can travel as a Colombian national or as a Mexican national for $100, cover a lot more of a distance between two cities, and I cannot cover, and I have to pay $400 an app to travel between San Jose and Guatemala, for example, or El Salvador and San Jose. So there are obviously, I'm not sure if these are design issues, probably not necessarily liberalization issues, more the type of things that you need to investigate. Obviously, these countries are treated themselves as foreign countries, so you have to pay the landing fees that you pay when you come from New York, even if you are coming from El Salvador. So that means must be relatively high, and the taxes per passenger. So I don't know. We will have to talk a little bit with the industry and understand why is it that low-cost innovators are not coming in, and if it is, what is deterring them to offer tickets at $50 that we see, for example, coming in some of the low-cost airlines in Peru or Colombia. Viva Colombia, Viva Peru, just to say one. So I think the details or the integration of goods and services, I see there are things that we all need to point out and identify, and I say we meaning in the private sector especially, but also obviously with our help, bilateral or multilaterals, and then focus the attention to just have them done. This is not, there are also infrastructure needs, and I think crossing the borders, we've seen pictures of everyone. The trucks move at 12 kilometers per hour in the first 3 months of this year between El Salvador and Costa Rica. I have the data, 12 kilometers per hour. This is not lack of infrastructure. This is obviously, it's been stopped all the time. I mean, the previous measure, we had it at 18, so we were a bit more optimistic, 18 kilometers per hour. So you have certainly a major problem. Goods, services, capital. I think capital, the countries have done a lot more. One see a lot more cross investments between for example, Salvadorian companies into the other countries, or Costa Ricans or Panamanians or even Nicaraguans. So I think the issues of the flow of capital has been a bit more resolved. I'm not saying they are just perfect, but I think goods and services is something where I will put the finger on. By the way, Latin America is an awful example, so we're going to have to learn from Asia or from Eastern Europe, because otherwise our own Mercosur and the Pacific Alliance, I mean, it's not going to give you enough examples.
Yeah, I had the pleasure of my career to be 2 years the chairman of an APEC committee, the Small and Medium Enterprise Committee, and I can tell you that from my experience there, East Asia and Pacific, particularly with respect to small and medium-sized enterprises, they're way out in front. So we have about 10 more minutes, and there are a couple of questions that have come through. I'm not quite sure the first one that has come through is really fair to this panel, but I'm going to ask it anyway. As one of the attendees noted, said Congressman Torres said yesterday, quote, "Without security, there's no way to expand investment or tourism." Are there any comments? Anybody want to address that issue? You touched on it a little bit, Pedro, but I'd like to give some others, the other panelists, an opportunity, if they're so willing.
Yeah, I can comment on that. Within Fundesa, we've been following up on security issues through a coalition with the government. And what we see is that definitely there is an important issue on how Guatemala has reduced its homicide rate from 46 to 15 homicides within the past 10 years. So 15 per 100,000 people is the current homicide rate within Guatemala, and that has also happened within other countries of the Northern Triangle of Central America. One of the key issues that we see is that local governments are working closer with national governments that is increasing its capacity to have technology, but also with the efforts on opening spaces, it also gives mayors a more proactive measure on how to reduce crime, specifically homicides, but also extortions. This is such an important topic for a country like Guatemala, because now our homicide rate is lower than Colombia or Mexico. Colombia, of course, was the example 10 years ago. So we understand that still 15 homicides per 100,000 people is high to OECD countries, but we think that within the next 5 years, if Guatemala and the rest of the countries of the Northern Triangle can actually reach lower rates between 10 to 12 per 100,000 people, then the countries will have an opportunity to really showcase the efforts and the solutions that have been implemented. Of course, with the support of many institutions, we recognize the efforts of INL on supporting the National Civil Police, for example. They have done a tremendous job on focusing on how to train better policemen and women, of course, and how to generate better capacity in human capital just in the security and justice forces.
Okay, thank you. Another question that has come up is, do the development banks coordinate their actions to avoid duplication and to maximize the impact of development?
I may take this, John, if I may. No, definitely. I mean, and it's we've been coordinating historically the development banks in Washington, the World Bank, the IDB, and also with the IMF. And this was clearly the case during the pandemic. To give you an example, the IDB approved most or a significant portion of the approvals last year were in the instrument, a special development loan, which is aligned with the emergency lending of the IMF. So it requires an IMF program. And we have meetings at different levels, from upper management to middle management to technical levels. So Pedro and I are familiar faces in our meetings. So there is obviously coordination and also going forward. So in all the areas I've discussed in terms of supporting the countries in vaccination rollout, policies for the recovery, etc., we are well coordinated. So this is, I think, important also for the government, so that there is a minimization of overlap and there is synergies and complementarities between our actions.
Thank you. And I guess just one note for all my panelists: do you all have your microphones on? Because I had one comment that not everybody can hear you. Now it says we're all on. Okay, that's good. That's good. So another question that came up is has to do with financial disasters, and since they seem to be endemic to the region, and are the things that the institutions that the banks are putting in place to deal with them as they to make the region more resilient? We got cut off.
We hear you. I don't know if Metodij wants to say something. I can also mention a couple of things that we're doing.
Okay.
Please, Pedro, thank you for the question. Actually, we have been, as you know, the climate change and the climate change risks and all the issues related to this very important phenomenon has been on the top of our policy and analytical agenda at the fund, especially in the recent period. And what is very important to mention here, especially when we are talking about the region, is that the region is one of the regions that has the smallest contribution to global carbon emissions and other type of climate change elements, but at the same time is the region that suffers. It's one of the regions that suffers the most out of the climate changes and all the uncertainties related to it. So in this way, what we have been doing, we have been working a lot in terms of the analytical work on climate change, and we're working on a study which is going to be prepared soon for the countries of Latin America and the Caribbean. It actually analyzes exactly these issues. And I would like to emphasize the great cooperation we have had with the IDB, the World Bank, and the others who are actually working on very specific instruments, both in terms of the financing, of providing financing for disaster risk, and at the same time on infrastructure and other issues. So just I guess Marta or Pedro may want to jump in terms of the specific instruments, but what I wanted to just mention is that our work has been covering issues going from climate change mitigation policies to adaptation policies, and basically analyzing some good examples, including from the region. And this is something that, taking stock of this, is something that's gonna help the region. As I mentioned, one of the regions which is most exposed to such issues, but at the same time, it's one of the regions that contributes the least. Thank you.
Thank you. And I hate to cut it off, but I've been informed that the next we are going to turn into pumpkins in about 1 minute. And so I apologize, Juan Carlos, that we weren't able to get a question to you. But again, I wanted to thank Marta, Metodij, Pedro, and Juan Carlos. They were excellent presentations. I remind all the registered participants that the entire session will be available for 6 months on the WHOVA platform, and all the presentations will also be available on that platform soon to registered participants. And so thank you again for your attendance, and thank you. I thought it was a fantastic panel, extremely enlightening.
Thank you very much.
Thank you very much.
Thank you, John, and everyone.
Have a great day.
Thank
All right.
you.